So we were doing valuation of firm, valuation of strategy, valuation of equity. In that context, let us do this problem. uh, Hope you got the question. This one is slightly tricky question, lengthy one, so may not be asked in the exam, but still I get many doubts from students on this particular question, because the way in which this problem is solved in the institute solution seems different from others. So let us do this. So it's going to take some time, so have patience with me, but it is going to be the normal method only. But somehow institute has solved in slightly different way. I'll show you that as well. Let's go forward. Hope you got the question. BRS Inc deals in computer and IT hardwares and peripherals. Expected revenue for the next 8 years is as follows. So we don't have to compute revenue for every year by sales growth. They only have given the estimated sales directly. The growth percentage need not be applied. Summarize the financial position on 31st March 2012 was as follows. Equity stocks, bonds, fixed assets, current assets. Additional information. Its variable expense is 40% of sales revenue and fixed operating expenses are estimated to be as follows. So variable expense is 40% of sales revenue. So sales revenue they have given every year separately. 40% of that becomes our variable expense. Fixed expense they have given separately, and these are fixed operating cash estimations. What do you understand by the word specific cash? Why they have not given, why they have given the word cash here? It means it does not include depreciation. Depreciation to be taken separately. Additional advertisement and sale promotion campaign shall be launched, requiring expenditure as per the following details given. Fixed assets are subject to depreciation at 15% as per WDV method. The company has planned the capital expenditure for the following coming 8 years as follows. Period 1 to 8, amount dollars in million. Okay, everything dollar in million, that is just, don't worry about the dollar symbol. It is just a regular valuation problem. Investment in working capital is estimated to be 20% of revenue. That is the working capital balance. Applicable tax rate is 30%. Cost of equity is estimated to be 16%. Free cash flow to the firm is expecting to grow at 5% per annum after 8 years. With the above information, you are required to determine value of the firm, value of equity. Okay, we have to calculate both value of firm and value of equity. Okay, so we need value of the firm. For value of the firm, what do we require? We require free cash flow to firm, FCFF. Value of equity, ideally require free cash flow to equity, but I will not follow that method. As we discussed in the basics, I compute the value of the firm, I subtract debt, I get the value of equity. So we have to calculate, how do we calculate free cash flow? We are going to do with profit after tax plus depreciation and adjust for working capital and capital expenditure. Capital expenditure, they have not given percentage of sales like we used to do in other regular problems. They have given specific numbers. So as usual, we will do 3 working notes basically regarding computation of depreciation, regarding capex increase, purchase of fixed assets, and third, working capital increase, working capital change. So this working note we'll do first, then we'll go for the tabular presentation. Okay, let's do working notes. They have given the purchase of fixed assets and all. So you'll be able to calculate easily the value of fixed assets and depreciation. So let's calculate. Purchase of fixed assets, I don't require working note. They only have given. So let's calculate just the depreciation. And which method they said we'll follow? We'll follow WDV methods. And you know format of WDV methods, how we are going to calculate. One second. System is taking time. Okay. So we'll follow a tabular format like opening balance, additions or depreciation, just 1 second. Just 1 second. Okay, so opening balance, then whatever purchases, then depreciation, closing balance. Okay, so opening balance is 70, purchases is 0.5, depreciation is at the rate of 50%. So on 17 plus 0.5 into 15%, 2.625, let's say 2.63. So closing balance becomes 14.37. So next year opening balance is 14.37. So this purchase of fixed assets, they're not specifically given on which day of the year they are purchased. So you can assume it is purchased on the last day, or you can assume it is purchased on the first day. I'm assuming it is purchased on the first day of the year. If you assume it is purchased on the last day of the year, at the end of the year, then you will have to compute the depreciation only on the opening balance. I hope PPT is visible. On 14.37, okay, what is the purchase in the next year? Second year purchase 0.8. Closing is 14.87, is it? Okay, 14.87. Okay, fine. Correct, 14.87. So 14.87 becomes the opening balance. And additions is 0.8. So depreciation will be 14.87 plus 0.8 on that 15%. 2.35. So closing will be 14.87 plus 0.8 minus 2.35. 13.32. That will be opening balance for next year. Purchases 2. So tell me how much depreciation you will get it as. In the exam, you can avoid writing closing balance because anyway, that will become opening balance for next year. You get 2.3. I'm not showing calculation. Hope you'll be able to understand. And the closing balance 13.02. Purchases 2.5. Depreciation 15.5. 2.5, 15.5. So 2.3. 2.3. So closing balance 13.02 plus 2.5 into 15% is 2.33. So 13.02 plus 2.5 minus 2.33, 13.19. This becomes the closing opening balance. Next year purchase 3.5. 13.19 plus 3.5 into 0.15, 2.50. So 13.19 plus 1, 14.19. After 3.5, 2.5. So 14.19 plus 2.5 into 15%, 2.5 again. Closing balance 14.19. 1.5. 14.19 plus 1.5 into 15%, 2.35. So closing balance 12.34. So 2.35. Sorry. 2.3, sir. Okay. So 2.35 means 13.34. 13.34. Additions is 1. 13.34 plus 1 into 15%, 2.15. So closing balance 12.19. I think 8 years over. 1, 2, 3, 4, 5, 6, 7, 8. 8 years over. Okay. So depreciation 8 years is done. Please check if the numbers are fine. Okay, is it done? Depreciation parts. So we required 3 working notes basically. One was regarding the capex purchase, which we don't have to worry because it is already given. Second is about depreciation calculation, which you have done. And the third thing we require is about uh, working capital, increase in working capital. Okay, is it done till here? Okay. Next, calculation of working capital change. Again, let me do it in the vertical format or horizontal. I think I can do both ways. Anyways, so let's do it based on sales. They have given the sales. And what about working capital percentage? They said investment in working capital is estimated to be 20% of revenue. Revenue they have given already for 8 years. So they have given the table already. You just need to multiply it by 20% each. So you'll get the working capital. So let's calculate. So here 0 to 8 I'll write. Okay. So working capital. Year 0 is from the balance sheet. I think 3 million something. Year 1, 20% of revenue you can take. How much you get? 20% of sales. 20% of sales. 20% of 8. I think 1.6. Like that you please calculate. Then 2. Then 3. 4.46. 5.2. 4.6. 4. Please confirm if the number is fine. 20% of revenue. 20% of 8. 20% of 10. 20% of 15. 20% of 22. 20% of 30. 20% of 26. 20% of 23. 20% of 20. Fine. So working capital is done. We need change in working capital. change in working capital. So from year 0 to year 1, can you tell me what is happening in the first year? 3 becoming 1.6. Current working capital, 3, it became 1.6. That means it is reduced, decrease in working capital, right? So decrease in working capital is 1.4. I'll say within brackets, decrease. And then increase 0.4, 1, 1.4, 1.6, and then again decreased, is it, in the 6th year? 0.8, decreased, 0.6, decreased, 0.6, decreased. Just give me 1 second. Make sure you write till there. Just 1 second. Something is wrong with the calculations. Okay. So this is what the change in working capital looks like. Working capital decreased. So what institute has recommended, you can think other way also, is institute has done like this. Please observe. In the first year, working capital decreased. What do you mean by increase in working capital? What do you mean by decrease in working capital? Increase in working capital means we have to invest additionally out of our pocket. So the amount will be invested in working capital. If it is decrease in working capital, we take the money out. So what institute has done in the first year, initially, instead of putting the money in and then getting the money out. See, initially first year, decrease in working capital because it looks like you have sufficient working capital on your hand. So what institute has thought, why to take it out first year, then put it in subsequent years. Institute has done, first year you will not take these out. Understanding my point, my dear friends? First year decrease in working capital means withdraw from the business like that. And then second year increase means again you have to put out of your own pocket. So what institute has thought, why to take the money out and then why to put the money in? Let's not do that. So first year they thought, let's not go for this withdrawal business. Let's keep the working capital at, let's not make it as minus 1.4. Let's keep it as 3 itself. Let's not change it. Let's not go for the decrease. What will happen then if I keep it as 3 only? If I keep it as 3, what would happen? I'll just say revised working capital. Opening balance is 3. Closing balance also, I'll keep it as 3 only. I hope understand what is the logic behind this. Closing balance also, I'll keep it as 3. So what would happen effectively in the first year? It would become 0. No change. No change in working capital required. Second year onwards, they have not done that. Second year onwards, they said, okay, we can do that process. Because first year they had the sufficient things. Anyway, they wanted the money for the second year onwards. So first year alone, they made it as 3. Second year onwards, they did the net calculations. So I'll just show you the number. So revised working capital 3. So the change in working capital becomes 0. Hope the PPT is visible. So you had the working capital of, the whatever current account balance working capital of 3. You were supposed to maintain 1.6. So effectively, you were supposed to reduce to 1.4. But what you did, instead of doing that, you did not do it. Okay. Let me show you one more way. What actually it means. What is the meaning of this? I'll tell you this. First, you write down till here, change in working capital. Then I'll tell you the revised thing. First of all, are you done till here? Revised one, I'll tell you freshly. In a normal problem, we would follow this process. Change in working capital, we take it to the free cash flow calculation. But in this problem, okay, just observe. Change in working capital is this. And what about capex purchase? Capex purchase. Just tell me the amounts. Okay, we have the above only we have table 0.5, 0.8, 2, 2.5, 3.5, 2.5, 1.5, 1. Correct? This is the capex purchase. So what is the net investment if I take it? Minus 0.9, and this is 1.2. This is 3. This is 3.9, 5.1, 1.7, 0.9, 0.4. Please confirm if these numbers are fine. Okay, hope these calculations are fine. You look at the first year alone, the net investment is outflow. Remaining years, net investment is fine. First year is actually minus. Minus mean actually investment, minus means what? Inflow. You're withdrawing. Because you have surplus capital, current assets, you are withdrawing. You are having surplus cash flow. Whereas other years, you have to invest. So what institute has done? Simply this. Listen to me carefully. 0.9 you had having surplus in the first year. Subsequent years, anyway, outflow is there. So what they think why would you want to make uh, an inflow in first year and outflow in the second year? Let's make it as zero and net amount only in the second year. You're understanding, right? If you have 10,000 and next year you are going to spend 40,000, so why do you take out 10,000 and spend 40,000? You keep 10,000 with you and invest additionally 30,000. Are you getting my point, my dear friends? You're having 10,000. You want to achieve 40,000. Instead of taking 10,000 out and next year putting 40,000 in, it's better you have 10,000 with you and invest only 30,000 extra. Ultimately, you make it 40. So inflow outflow will get adjusted. Are you getting the point? Why this problem is different from other problems? In other problems, we were having only increase in working capital, purchase of capex, all are outflows. This issue was not there. In this case, in year 1, we are having a surplus of 0.9 and subsequent years, we are having outflow. So instead of taking the 0.9 out, keep it with you only. Don't withdraw 0.9 and you don't have to invest 1.2 next time. You can invest only 1.9 1.2 minus 0.9, only 0.3 next time. That is additional investment required. And rest are all same only. Rest are all positive, no problem. So rest are all will come to the same numbers. Please confirm. Did you get this point? Only this part, even though it is minus 0.9, I'm making it as 0. And this 0.9 I'm adjusting here. So this becomes 0.3. Rest are all amounts remaining same. See, effectively this 1.2 minus 0.9 becomes 0.3 only. Only time value of money will change, that's all. I hope this is easier to understand. I'll show you what Institute has done. If you want, you can understand that process as well. Okay, I'll show you what Institute has done. If you want, you can follow that process. Observe. So they have given capital expenditure. This is given in the problem. Then sales into 20%. They got the current assets. Then they did the total of this. Then they did the existing investment in current assets and they see how much additional investment required. So 3 is the existing investment. Amount required 2.1. So additional investment required was 0. Why? Because you have more amount than what is required. In our calculation, what we told, a 0.9 is going to be outflow. I mean, withdrawn. But withdrawn, when that's a surplus, was not required. They said 0. They are not told minus 0.9. They made it 0. That's what I'm also making it. And then this 3 becomes 2.5. How? They have purchased 0.5 existing investment. Then this total 2.8. 0.8 plus 2. 2.8 minus 2.5 becomes difference 0.3. And then from 2.5, they have purchased the capital expenditure 2. So this has become 2.5. They have purchased 0.5 additional investment. That has become 2 or the whatever. So 2.3, 2.5 was existing investment, 0.3 additional investment. So this became 2.8 minus capital expenditure what they spent, that becomes 2. Then 2 plus 3, 5 minus 2 became 3. 3 plus 3.9, 6.9 minus 2.5 became 4.4. Like that they have calculated. Many students think this is confusing. That's why I have not followed this tabular method. I followed this our regular method of working capital increase and purchase of capex, and how they are different, why they are different in the first year, I showed you. When they say working capital is 20% of revenue, isn't it net working capital they are telling, meaning after considering capex? Yes, after considering capex. That is why next year when they're calculating, they're subtracting capex. When they're calculating existing working capital, existing calculation, do you require this table? We have already calculated directly, right? The same answer we got. See 0, 0 0.3, 0.3, 3.9. We got the same numbers. I just told you so that institute has done like this. That too in one problem. And people believe this is confusing because we have not done this in other problems. Why we have done this in this problem? If you want, I'll explain this table again. No problem. If you want, I'll explain. But keep it in mind, the more time we spend on the extra things, our time on other problems gets reduced. So I will be doing less problems. If that is what you want, I will do it. I have nothing to lose. Let me explain this table. I hope the previous question is answered first of all. That this capex, this current assets amount is after capex. That's why this amount is calculated after subtracting this. That is from 3, you subtracted 0.5. That's how you get 2.5. 2.5 plus 0.3 additional. So it became 2.8 totally. Then you spend the 0.8, it became 2. So this current assets is after, this is the current assets calculation, existing current assets calculation after capex. This is the current assets you have to maintain. So difference amount is the additional amount that you have to maintain. Anyway, so if you want to explain, I'll explain this table, no problem. If that is what you want to understand, let's go ahead. Okay, so what is that capital expenditure? This table given, first column. Second, capital asset, current assets, working capital. This is working capital or current assets to be maintained. Current assets to be maintained. And they did total. That's how you got the third column. So 3 columns are clear. Then they compared what is actual current assets balance versus what you have to maintain. So first year, 2.1 is the required current assets plus capital expenditure. You have 3. So 0.9 is surplus. They said don't take the 0.9 surplus out. Keep it 0 only. So next year, how much, what will happen? This 3 what you had, the total investment, capex plus current assets, total what you have out of 3, you have spent 0.5 on capex. So out of 3, if you spend on capex, what will it become? 2.5. So 2.8 is the capex plus fixed assets plus current assets that you have to maintain. But what you're investing is only 2.5, and therefore 0.3 additional investment required. So what will happen to this balance now? 2.5 we are having. We require additional 0.3. So total becomes 2.8. This is existing investment, not just current assets, existing investment actually. Anyway, so 2.5 plus 0.3, 2.8, because 2.5 we had, 0.3 we had got. So 2.5 plus 0.3, we have 2.8 now at this stage. If you want, you can have one more column, revised. Here we have not spent anything. This continues to be 0. And here 2.5 we have, additional investment 0.3. So this becomes 2.8. Out of 2.8, next year you have spent capital expenditure 0.8 that you will pay out. So what will happen to the next year balance is 2. And out of this 2, next year, what you spent is 2. That's what we got here 2. What is next year? 5 is what your investment required. 2 is what your balance. So additional requirement is 3. So once you spend 3, you had 2. Total becomes 5. Out of 5, you spend the 2 capital expenditure. Balance becomes 3. Like that, they have done. In fact, you observe this nothing but next year balance 2. This is what next year amount. This is 3 next year amount, 4.4 next year, 6 next year, 5.2 next year, 4.6 next year. That's how the existing investment in current assets amount is calculated. Anyway, so did you get this? Oh, okay, I'll complete this table. Why you should ask that problem? I'll do that also. Okay, so existing investment 4.4, additional investment 5.1. So 4.4 plus 5.1, that is 9.5. Out of 9.5, we spend 3.5. That's how then it becomes 6. That's how this 6 will be obtained. Then we require 1.7. It is 7.7. Out of 7.7, we spend 2.5. Then 5.2 will remain. Then 0.9 additional investment. So that becomes 6.1. 6.1 minus 4.6. Then it is going to be 6.1 minus 1.5 is 4.6. Then 4.6 plus 0.4, that becomes 5. But instead of that, what I thought is simpler one. Instead of doing that current assets minus and all, let's follow regular process. What is regular process? Working capital change. Calculated. Capex. Given. This is in line with our previous problems calculations. The only problem what is happening, in the first year, you are having a surplus cash balance because of decrease in working capital. So what you thought, instead of going out minus 0.9, you adjust it in the second year. So first year, don't withdraw anything. That's how this 1.2, I made it as 0.9. 1.2 minus 0.9 as 0.3. Effectively, you see, minus 0.9 in the first year, 1.2 in the second year. Net amount is 0.3 only. That's what I've done, net amount 0.3 directly in the second year. So instead of taking out in the first year, putting back the money in second year, net amount only I'm putting back in the second year. Thereby, the net of setting off is taking place. Mathematically, it is same. Only first year, second year, time value money is the impact. The rest of the years remain same. So I thought this confusing table could be avoided with regular table. Anyway, since you asked for the institute solution, I've shown you that as well. Any doubts still? No response? Okay, I'll wait, since maybe you're taking down still. Okay, we can continue. Thank you. Okay, so let's go for our annual free cash flow calculation. This should be straightforward. So year 0, 1, 2, 3, 4, 5, 6, 7, 8. So let's start with sales. What they've given. Year 0 not required actually. Directly we can start with year 1. Uh, 8, 10, 15. Oh, one more thing, one more working note required. Let me just go back. I forgot. Can you think what is it? One more working note required? Or if I ask the question directly, because I'm not getting much response today, I'll ask the question directly. Have they given the discounting factor or should we calculate it? Discounting rate, cost of capital, have they given or should we calculate? Okay, I think I don't get a response for that also. I'll give the answer myself. They have given cost of equity to be estimated as 16%. Cost of equity is KE. But for valuation of firm, we require KO, that is overall cost of capital or WSCC. And cost of debt will be the rate of interest into 1 minus T. Rate of interest into 1 minus T. So 12% is the rate of interest into 1 minus T, we get the cost of debt. So we have cost of equity, we have cost of debt. If I take a mix of both, I'll get KO, weighted average. And what is going to be our weight? Ideally, we should take market value, but market value is not available. Let's go for book value. Equity 12, bond debt 8. So let's calculate that working note and then we'll go for a regular calculation. I think this space should be sufficient. So cost of equity K equals 16% given. Cost of debts KD, rate of interest into 1 minus T. Rate of interest is 12%, tax rate 30%. So 12 into 1 minus 0.3. 1 minus 0.3 is 8.4. So overall cost of capital WSCC or KO is cost of equity 16, its weight I think 12 out of 20 plus cost of debt 8.4 to into its weight 8 by 20. Sixteen into 12 by 20 m plus 8.4 into 8 by 20 m plus MRC I think 12.96. 12.96. For calculation purpose, you can round it off to 13 for convenience. Anyway, let's take 12.96. So you can, in the exam, actually institute has rounded off to 13, but let's keep it at 12.96. You can do 13 also, 12.96 also. Both are fine. This is cost of capital. Okay, let's go further. Okay, so we are doing sales given, so no need to worry. Eight, 10, 15, 22, 30, 26, 23, 20. less expenses. Variable expense, I think they're given 40% of sales. So 40% of 8, 40% of 10, and so on. So you get 3.2, 4, 6, 8.8, 12, 10.4, 9.2, 8. 40% of sales, 40% of 8, 40% of 10, 40% of 15, like that. 40% of sales, that is revenue, is your expense. Then fixed expense, cash. That's also given. Of course, depreciation we have to do separately. This is again given. 1.6, 1.6, 1.6, 2, 2, 2, 2. This is given. Where is given? Fixed expenses. First 4 years, 1.6 each. Then next 4 years, 2 each. Again, you have to understand from the interpretation. You should not look at literal things every time. I know some people think like this. Sir, year 1 to 4, they said 1.6. So, should I do 1.4 divided by 4? This is total for all the 4 years put together? No, 1.6 each every year. Sir, where they have given? It is not given but understood. That's why I told you SFM is not a legal subject to interpret with case laws and section numbers. Maybe in future that also may come. Who knows? But as of now, at least, it is not coming. Because, we are becoming chartered accountants. But what are the subjects we are reading? We read company law. There is a course for that. Company secretary course. CS. We read costing. SCM. There is a course for that. That is called as CMA. We read law, economic law. There is a course for that. Lawyers, LLB, separately. We read information technology in IT, SM, EIS and all. Software people will read that. Then SFM, financial management, MBA finance people will read that. Then what is the actual our core area? Is accounts and audit. That's all should be our subject. But that is not the case. We are reading everything together. Rather than thinking this way, think other way around. Because I think most of you did in a CA intermediate, you had 8 subjects. Your seniors had 7 subjects. I had 6 subjects. What will your juniors in the future will have? So if I apply on those lines, as of now, you should be happy you're having only this much subject. In the future, I don't know what else may come. SFM Act also may come. Because everything is bound by legal boundaries. Anyway, we Indians don't follow rules, laws. But one more SFM Act 2050, preamble, section, definitions can come. Then you can argue more on this case laws and all. And apart from this subjects, maybe we can also have like medicines as one of your elective subjects. What else CA should know now? Because you have to certify everything. No? So you should know everything in the world. You're giving audit report regarding violation and all. So chemicals also you have to know. H2, SO4, CO2. They can give you all these amoeba standards maybe. I don't know what and all can come in the future. So before they should come, I would request you to pass the exam at the earliest. One thing I should tell you, honestly, when you pass CA exams, let me tell you this clearly. When you pass CA exams, I've experienced myself, I've observed in many people. You're happy not because you became chartered accountant, you're happy because you no longer have to write the exams. The pressure of not writing exams is more than becoming a chartered accountant yourself. Anyway, so keeping that in mind, let's go forward. So still our interpretation part. So interpretation is this is each year, not all the 4 years put together. So that's about fixed expenses, cash. Then they also have given advertisement expenditure, depreciation we calculated. Let's calculate those things. Advertisement cost given already. So you just have to make use of it. 0.5, 1.5, 1.5, 3, 3, 3. That is for last 2 years, and then year 3 to 6 and all they have given. Then depreciation, we only calculated. This depreciation, we have done the working note. Actually, we should not write the last year rate. We should write year rate onwards. Anyway, let's keep that aside. So we get total expenses. Sales is there. Total expense, we can do total if you want, or you can directly write profit. Total expenses. Add all these numbers. See if you get these numbers: 7.93, 9.45, 15.73, 19.5, 17.9, 14.55, 13.15. So sales we have, expenses we have. If I subtract, I get EBIT. So 8 minus 7.93, 0.07. 10 minus 9.45, 0.55. 15 minus 11.4, 22 minus 15.73, 30 minus 19.5, 26 minus 17.9, 23 minus 14.55, 20 minus 13.15, you get EB8. Okay, actually, you need to have one more column. Okay, I just write at the bottom. I don't have space, but hopefully you understand. Because year 1 to 8 we have written. Next year onwards, the cash flow will stabilize. Because we say that year 1 to 8 they have given, 9th onwards, where we have to calculate terminal value. But anyway, I'll write it later. I hope you'll be able to understand that. Okay, so EBIT, we have got it. What is the next line? Can you tell me? EBIT, we have got it. What is the next line? Normally, people think the next line will be interest. So, EBIT minus interest, EBT. No, interest should not be subtracted. Hope you remember, we have discussed in the basics. I'll quickly revise that aspect. For two reasons, we should not consider interest. First reason, it is like an appropriation for the firm. So if you compute equity shareholders, dividend paid, you will not take it as a expense, right? Because it's an appropriation from the equity shareholders point of view. What is available to him. Similarly, when you think from the firm's point of view, interest will not be considered as an expense. It will be like an appropriation because firm will include debt also, equity also. So dividend is also an appropriation, interest also an appropriation. It's not an expense. One way of understanding. Other way of understanding, like the way I give an example of house property. So when you think the valuation of house, interest part you don't subtract. Rental income when you consider. Because that interest is from owner's point of view. From the firm's point of view, from the house point of view, interest should not be subtracted. Same logic holds good. When you valuing the valuation of firm, it is irrespective of capital structure. So interest should not be considered. So let's go for tax. You can do directly into 1 minus T. We can directly go for profit after tax or no PAT, net operating profit after tax. Or you can also say tax at 40%. That also you can do, or into 1 minus T. That is also fine. Okay, so I'm deducting tax. You can directly do 1 minus T also. So after rounding it off, so 0.02 I get 0.07 into 0.4. You get 0.028. 0.03 I think I should have got. Okay, so 30% tax, not 40%. 30%. So 0.07 into 0.3, 0.021. I'll take 0.02, rounding it off. So this will give me no PAT, net operating profit after tax. If it is for equity shareholders point of view, I would have told PAT. You get 0.05, 0.39, 2.52, 4.39, 7.35, 5.67, 5.9 to 4.79. Okay, then we'll add back depreciation and we'll have to subtract two things. Capex we have to subtract, and changes in working capital we have to subtract. Rather than that, we already calculated net amount. That is capex, net investment we already considered. So I can subtract net investment directly. Depreciation as above, 2.63, 2.35, 2.3, 2.33, 2.5, 2.5, 2.35, 2.15 as calculated in the table above. Net investment, we have done the working notes. We can use that. That is 0.333, 3.9, that one. So these things you can subtract. You get FCFF, free cash flow to firm. CFF. So 0.05 plus 2.63 means 2.68. 2.44, 1.82, 2.82, 4.75, 6.47, 7.37, 6.54. The title, net investment, additional investment, anything you can write. You can also write working capital separately, capex separately. That's all your convenience. As I told you, this is not a law. So titles are not defined. They are all in the situation, whichever you think is appropriate, you can adopt. Net investment also you can say, additional investment also you can say. Okay. This is year 1, 2, 3, 4, 5, 6, 7, 8. Year 9 onwards, one terminal value will get, right? So I don't have space, so I'll write it here at the below. Hope you understand. Terminal value. Basically, ninth year onwards. I was supposed to write one more column. I don't have space, so I'm writing it here. So terminal value, ninth year onwards means we get TV8. How do you calculate TV8? Cash flow of year 9. Cash flow of year 9 by K minus G, or cash flow of year 8 into 1 plus G. So 6.54 is cash flow of year 8 into 1 plus, what is the growth rate? Have they given the growth rate or not given? The cash flow from the firm is to expect to grow 5% after 8 years. That means 9th year onwards. After 8th year means 9th year onwards, it is going to be 5%. So 0.05 divided by K minus G. K was 12.96. We have calculated minus 0.05. So this value, as I told you, was supposed to be in the next column. I don't have space, so I'm writing it in the year 8 column. But actually, it was supposed to come in the next column. But anyway, the cash flow of year 9 means terminal value we get at the end of year 8 only. But if we had one more column, it would be more comfortable. Anyway, so that number will be 6.54 into 1.05. 0.1296 minus 0.05, 0.0796, 0.0796, 86.27, that's all. Okay, maybe. $86.27. Okay, let's apply discounting factor at 12.96. One by 1.1296. Let's say 4 decimals. 0.8853, 0.7837, 0.6938. 0.6142, 0.5437, 0.4813, 0.4261, and last year also 0.4261. Just 1 second. I know people not visible. .4261. Last 2 years will be same. 0.4261. Okay. Point 377. No? Okay, sorry, sir. 8th year, correct. 0.377. Okay, fine. 0.377, 0.3772. So that 0.3772. It should have come one more time, correct? That 0.3772 should have come two times. 8th year also 0.3772. Ninth year also ninth year onwards also 0.3772. So that number should come two times. So discounted cash flow, present value, 2.68 into 0.8853, 2.37, 2.44 into 0.7837, 1.91, 1.82 into 0.6938, 1.26, 2.82 into 0.6142, 1.73, 4.75 into 0.5437, 2.58, 6.47 into 0.4813, 3.11, 7.37 into 0.4261, 3.14, 6.54 into 0.3772, 2.47. And one more thing will come, terminal value also will come. That is 86.27 into same discounting factor, 0.3772, 32.54. Just 1 second. Okay. Hope you're able to get the last number. I was supposed to write one more column. 6.54 into 0.3772 is 2.47. Terminal value also should be brought down to today value. That is year 9 onwards. That means year 9 onwards means year 8 you get. And year 8 discounting factor 0.3772, you get 32.54. And so total value of the firm, add all present value, 2.37, 1.91, 1.26, 1.73, 2.58, 3.11, 3.14, 2.47, 32.54. Is it 51 something? 51.11. 51.11. If I subtract debt, we get value of equity. So value of equity, 5.11 minus debt. Debt amount is 8, I think, right? Bonds, 8. Okay. So 15.11 minus 8. 51.11 minus 8. 43.11. If you divide by number of shares, you get the value per share. If they ask. Anyway. You can remember these are all in millions. In the heading you can write these are all in millions. So as I told you, it's a full-fledged problem and the lengthier problem because 8 year and all is given. From exam point of view, I don't think they can ask so much. But anyway, just be prepared. Discounting factor calculation. 1 divided by 1 plus R. So 1 by 1.1296. Keep pressing equals to equals to equals to. You get every year calculation. Why we consider the equity ratio in the short formula FCFE. So in the FCFE, we want to calculate the cash flow attributable to equity shareholders. See, for example, when I'm taking the net investment, let's say this is, for example, 5.1. You can take depreciation also. Let's say I'll select this one first, 5.1. This net investment is the outflow for the entity, for the firm. But when you think from equity shareholders point of view, he will not give entire money from his pocket. In the sense, from the entity point of view, what happens? This investment, some source will also come from taking debt, taking loan, because you will be maintaining uh, debt equity ratio consistently. I mean, you'll maintain debt equity ratio. So if you want 10 lakhs, let's say 60% you take it from equity, 40% you take it from debt. So what is the cash flow impact on equity shareholders is only 60%. So when you take the equity shareholders point of view, from his cash flow, I will take the equity ratio. Whatever the cash flow for the firm, I multiply it by 60% so that I get particularly uh, the cash flow attributable to equity shareholders. So from the total cash flow of the firm, attributable to equity shareholders, I multiplied by equity ratio. In the full-fledged problem, it does not matter, because in full-fledged problem, the capital structure does not matter. The source does not matter. You are thinking from the entity point of view. The example I gave you already, I'll just give example once more. Let's see if you're able to get it. If house property value was 50 lakhs, if house property value was 50 lakhs, then if you're, 3 is to 2, 3 is from your own source, equity, and 2, that is 20 lakhs, 30, 20, let's say, from debt. And you are earning interest, you are paying interest. You're getting rental income, you're paying interest. If you spend 1 lakh additionally on improvements, will you pay out of your rental income? Free cash flow to you. From the building point of view, yes. From the owner point of view, in this 1 lakh also, if you take loan, to that extent, your cash flow will not be affected. Individual cash flow will not be affected. So if you take only 40% loan, so what do I do? For 1 lakh into 60%. 60,000 is the cash outflow from owner point of view. But 1 lakh is the cash flow from building improvement point of view. Hope you understand why we take equity ratio for FCFE. Anyway, we have done FCFF calculation. That equity ratio does not matter. Okay, cost of capital 12.96. I'll show you the calculations. Cost of equity 16 given. Cost of debt we need after tax. So 12% into 1 minus T, 1 minus 0.3. Then WACC, that is weighted average. 16 is the cost of equity multiplied by its weight, 12 by 20. Then debt, cost of debt multiplied by its weight, 8.4 into 8 by 20. 16 is cost of equity, weight is 12 by 20. 8.4 is cost of debt, and multiplied by its weight, 8 by 20. And where do you get the 12 and 8? From the balance sheets. We got equity stocks 12, bonds 8. So 12 and 8. So 12 by 20, 8 by 20. We got the WACC. Any other doubts? Though it looks like a special problem, lengthy problem, it looks like, but for me it's very, very regular problem. For the reason, it's just lengthy. And extra point what we are learning is this net investment or additional investment. Only this part was the extra element. Okay, hope you got it. Just mention somewhere this TV8 is TV8 into 1 plus G by KO minus G, or this is nothing but TV9 by KO minus G. TV9 means we get TV8, and this is reflecting cash flow of year 9 onwards. Cash flow of year 9 onwards. I was supposed to have one more column, did not have space, so try to show like this. Okay, hope it is done.